Welcome to the Daily Update Podcast, where I'll go over the action in the market for Thursday, July 3rd, and we'll see how things look for Monday, July 7th. I want to wish a happy 4th of July and Independence Day to everybody. In Thursday's session, the S&P 500 delivered a solid performance, closing up 0.83% on significantly lower than average volume due to the shortened trading session. The index gapped higher at the open, surpassing the R1 pivot point at 62.41, climbing above R2 at 62.54. While it didn't reach R3, the market was able to hold on to its gains, closing just shy of the intraday high. This resilience reflects a broader positive trend across all time frames, with growth stocks, particularly megacaps and semiconductors, leading the charge. However, there is a note of caution. The market is showing signs of being overextended. Sentiment is becoming exuberant, with investors seemingly interpreting all news as positive and buying into any dips. While this doesn't mean an immediate reversal, it suggests we're at a point where the market may be taken for granted. As we head into the holiday weekend, potential geopolitical risks and domestic uncertainties could introduce volatility, so caution is warranted. Going through the economic data that was released, the economic calendar was packed, headlined by a stronger than expected employment situation report. Non-farm payrolls came in at 147,000, surpassing expectations of 120,000. With prior months being revised upward, signaling continued labor market strength. The unemployment rate ticked down to 4.1% from 4.2%, though private payrolls were weaker at 74,000 against an expected 123,000. Average hourly earnings rose a modest 0.2% below the anticipated rise of 0.3%, which is a positive sign for easing inflationary pressures. Other reports provided a mixed but generally constructive picture. The trade balance showed a larger than expected deficit at minus $71.5 billion, while weekly jobless claims dropped to 233,000, better than the 244,000 that was forecasted. The ISM services rose to 50.8, indicating expansion, and factory orders grew a robust 8.2%, exceeding expectations. However, rising interest rates are a concern, with the 10-year yield climbing to 4.35%. If it approaches 4.5%, it could pose challenges for stocks. Looking at the technical analysis and market sentiment picture, from a technical perspective, the market is firmly in bullish territory. The S&P 500 just had a recent confirmed golden cross, with the 50-period moving average crossing above the 200-day moving average, a strong signal of long-term bullishness. However, several indicators suggest we're overbought. The Stochk RSI, CCI, and stochastics charts are extreme, while the McClellan oscillator is in extreme territory as well. The S&P 500 is trading well above its 20 and 50-period moving averages, even entering a rare +4 standard deviation channel. Advanced decline ratios and momentum oscillators reflect broad market strength, particularly in growth sectors including tech and semiconductors. This was partly fueled by news that the Trump administration lifted restrictions on chip design software exports to China, boosting the sector despite security concerns. Sentiment is also at an extreme high, jumping to 78 from 63, which raises a caution flag. While the trend remains positive, this level of optimism often precedes a slowdown or profit-taking. Looking at sector and market trends, growth stocks outperformed value stocks on Thursday, with large, mid, and small cap growth ratios showing improvement. The financial sector, helped by a successful bank stress test a week ago, hit an all-time high, with the bank ETF showing notable strength. Defensive sectors, including staples and real estate, lagged, while discretionary communication and technology had gains. The FANG index, representing megacap tech, also set a new all-time high, with positive performances from Google, Meta, and Nvidia. Looking at bellwether sectors, semiconductors, retail, and regional banks are showing strength, signaling broader market participation and confidence. However, a negative divergence between the NASDAQ 100 equal weight and S&P 500 equal weight is a bit of a concern. The Nasdaq 100 hit an all-time high, which was not confirmed by the S&P 500 equal weight index. If broader participation continues, it could further bolster the rally. Looking at the outlook for Monday, July 7th, with no economic reports scheduled for Monday, there might be a quiet session, though holiday weekends can bring unexpected volatility. Seasonality is in the market's favor, as early July historically marks the strongest period of the year for half a month, with positive returns for the Dow, S&P, and Nasdaq. That said, geopolitical risks, such as tensions between Iran, Israel, Russia, and Ukraine, remain in the background, as do domestic uncertainties. The market's confirmed uptrend and positive momentum are encouraging, but overbought conditions suggest at least a potential slowdown. Investors should watch the key S&P 500 pivot points, monitor growth stock performance, and keep an eye on the 10-year yield, particularly if it nears 4.5%. The economic calendar picks up a little bit later in the week with consumer credit on Tuesday, the FOMC meeting minutes on Wednesday, and initial and continuing claims on Thursday, which could set the tone for the market. In conclusion, the market is riding a wave of optimism, driven by recently released stronger economic data and leadership from growth sectors. However, overbought signals and an exuberant sentiment environment remind us to stay vigilant. As we enjoy the 4th of July weekend, let's hope for safe celebration, barbecues, fireworks, all without incident. I hope you found this podcast helpful. For more in-depth analysis and commentary, the full-length daily video update is available on YouTube and Rumble right when the market closes each day. To access the videos immediately after they are available, or to access the daily newsletter, please click on the links below.